This is Tom again from the Home Loan Bank, here with some Home Loan Bank staff, specifically Angel Santos. For those of you who have not met him yet, he is the individual who's going to be covering credit unions, or has been covering credit unions in New York and in New Jersey, and he's comes from a long credit union history. He's been 20 years in the industry, and most recently he was with the New Jersey Credit Union League. So we welcome him, and I believe this is his second session with this credit union webinar. But I appreciate all of your attendance. There's quite a number of registered credit unions this year. We have around 53 attendees representing 41 credit unions, and 2 of which are prospective members. So that's almost 50% of our credit union membership. This session is part of a series of webinars that we've conducted over the past several years. I believe the first credit union-specific asset liability management webinar was conducted in 2011. And again, that was with Darling Consulting, specifically with Frank Ferrone, who we have here today. And we've covered pretty much every topic dealing with asset liability management over the past several years. And this is going to cover kind of what's happening in the current environment. We have one Fed rate hike behind us, what the implications of that will be and are, where we're going from here, some strategies to consider. And interestingly enough, today's Groundhog Day, and like Groundhog Day, we're pretty much back where we started in 2011. We were in a low rate environment back then. Things have changed a little bit, but we're still at the same low rate environment. Still a lot of pressure on net interest margins. The long end of the curve keeps coming down, and a lot of pressure on the long end of the curve. The short-term interest rate hike, we're going to see a little more pressure on net interest margins. So with that being said, I want to turn it over to Frank Ferrone. He's Managing Director of Darling Consulting. He has a portfolio of 100 credit unions that he works with across the nation. He's got real strong opinions on what some balance sheet management strategies that you should pursue, or at least consider pursuing. So with that, I'm going to turn it over to Frank.
Thank you, Tom. Thank you, everybody. Anybody have any idea what we're looking at, or what the significance of this iPhone is? Last time the Fed hiked rates before recently, it was before the iPhone was invented. So we've been down in this low rate, protracted period of low rates ever since the financial crisis. And now, as Tom said, the Feds raise rates once. You know, some would argue, given all the things that are happening in the economy today, worldwide, global recession, negative interest rates, that it might be one and done, you know, for 2016. Others, including the FOMC, are suggesting that it might be 4 hikes this year. The reality is, nobody knows. So a lot of this uncertainty is creating a lot of pressure in the industry. And as I've said in all of the previous sessions that I've done, in all my seminars, and particularly for the credit union industry, low rates is not your friend. Most credit unions do much better as rates rise, whether we have a flat curve, a steep curve, but a higher rate environment generally favors most credit unions. So the fact that we're in this low rate environment is problematic. So the impact of these low rates for most of you is creating a lot of margin pressure. So it doesn't appear as if this is going to clear up anytime soon, based upon, you know, some more recent events and what's happening to the yield curve. One of the things that I think would be helpful, just to put some perspective on what's been happening in the credit union industry, is just to take a look at what's been happening since just going back to 2010. And that's really when we started to feel, right, the impact of that falling rate environment. If you look at the yield on loans and you compare that to your cost of funds, what's happening? Loan yields are coming down farther and faster than your ability to lower your cost of funds. For most credit unions, the yield on the investment portfolio, you know, that's come down as well. And all of you that have listened to me before and have heard me speak before, I've said, I mean, unless there is some compelling reason to have any excess cash sitting around, right? You'd be better served getting it out on the curve, right? And here we are today in 2016 with the 10-year Treasury in the 180 range as of this morning. You know, having put that cash out over the years has benefited your balance sheet significantly. On the other hand, those of you that have been sitting around with cash, high levels of liquidity, high levels of cash, low loan demand, are finding that this pressure has intensified, and if you look out on the horizon, it's only getting worse. Even if interest rates start to go up slowly, you're still going to see that margin compression. And so what we're going to talk a lot about today is what are some things that we ought to be thinking from a balance sheet perspective. And the credit unions are having very similar challenges that the banking industry has had. And while the reason I put this banking industry chart up here is just to show you how the larger institutions, bank institutions, have overcome some of this margin compression. And if you think about the commercial banking industry, a lot of their assets are tied to the short end of the curve, and they have been historically. So when you look at these red bars, right, it looks like we peaked right around the third quarter of 2011, right, in terms of net interest income. And then if you look at margins since that point in time, it's continued to come down, 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 right? And it's come down even further since the third quarter of 15. But levels of net interest income, while the margins are declining, have continued, to remain relatively stable. So that begs the question: what are the banks doing to help maintain that level of income? And basically, what they're doing is they're making up in volume what they're losing in spread. That's number one. And what they're doing is they're shifting more into loans versus low-yielding investments. And I think the same solutions are going to hold true for the credit unions. So one of the things that I think is at the uppermost concern for a lot of financial institutions, both banks and particularly the credit unions, is rising rates. There's been this focus that rates can't go any lower, and we heard that about 6 years ago from the chairman of the FDIC, Sheila Bair, and the fact that she said rates can't go any lower from here, there's nowhere to go but up. Ever since she made that statement, what's happened? Rates have continued to come down, 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 down. And now the feeling is, or it has been, that rates have to go up from here. So a lot of you are feeling a lot of pressure from the regulators, right? And this is nothing new. I educate the regulators. I do training for the NCUA and a lot of regulatory agencies, including FDIC, OCC, Federal Reserve. And I can tell you that this focus on rising rates is all of a sudden now starting to abate, because I think they're realizing now that this low protracted rate environment is not good for income for both banks and credit unions. So the question becomes, if we're focused on rising rates or we're concerned about rising rates, are you prepared? And probably the bigger question is, are you prepared if rates don't rise? And I think for most of you on this webinar today, that's probably the more important question. And we're going to spend a lot of time later looking at some different strategies and alternatives and things to consider to help manage through this protracted low rate environment. So when are rates going to go up? Well, they've gone up a quarter. How much are they going to go up? How fast are they going to go up? In other words, what's the pace of the expected change in interest rates? And while nobody knows for sure, it appears as if things are going to remain relatively benign in the near term. So let's talk a little bit about the difference between what we're hearing at the Fed, meaning the FOMC. Chairperson Yellen heads up the Federal Open Market Committee, and what they do each time they meet is each one of them, so to speak, cast their vote as to where they think the Fed funds rate should be at the end of certain periods of time. So in this case, 2016. If you look at these dots across the board, these are like the votes, right, of the people that sit around that table as to where they think the Fed funds rate should be. So let's just start with these dots down here. You've got some folks that think we should end the year at somewhere around 75 basis points. You've got others, or one other, that thinks we should be somewhere around 2.25. That's a pretty wide disparity among a group of folks that have the same information sit around the same table, right? If you go out farther on the curve, or farther out on the time horizon, 17, 18, and longer term, look where some of the folks sitting around that table think the Fed funds rate should settle in. Let's just go to 18, right? 375 to 4. I can tell you one thing, they've changed their tune over the last year and a half, number one, and number two, that's a very different outlook than what we're seeing in the markets, meaning the Fed funds futures market. So what I've done here is I've circled the median. That's the midpoint of all the votes, just to show you what the FOMC was thinking as of December of last year. How does that compare to what they've said, over the last 4 meetings that they met? Well, if we went back to December of 14, look where the median was back then. Look how far it's come down just since that time. The meeting in June of last year, it came down even further. And then if you look at September, it came down even further. And if you were to put those dot plots together today, what do you think they'd be? Yeah, you got it. It would be lower. That's the FOMC. How does that compare to what the market's expectations are? Look at the Fed funds futures. And I'm going to show you another graph in a minute. Look where the Fed funds futures is in 16 and 17. Compare that to where, and that hasn't changed all that much, but look at where the Fed funds futures is relative to the FOMC. Look where we were a year ago at the FOMC dot plot versus where we are today. So what's happening is the Fed is catching up to market expectations, right? So as of the December FOMC dot plot, the expectation was that we were going to see a 1% increase in 2016. In other words, 4 rate hikes. If you looked at the Fed funds futures market as of January 12th, right, now we're looking at maybe a half, maybe 75. So there's a big disconnect between FOMC and what we're seeing in the capital markets, and what dictates the slope of the yield curve. It's not the FOMC, right? It's the yield curve. It's what the market expectations are. That's what's going to impact the yield curves. For those of you who aren't familiar with or haven't seen this before, implied forward rates, this is just a swap curve. And just to walk you through this, if we look down at the bottom here, right, this is the slope of the yield curve as of, you look in the lower right here, January 12th, 2016. So that's the slope of the curve. Now, you could call it the swap curve. It's like the FHLB agency curve. And all those dots are plotted along the top. What we're looking at down the side here is, over here is, what is the expectation for all these points along the curve a year from now, 2 years from now, 3 years from now, and beyond? And what do you notice? It's showing a flatter, very sensitive touching here. What it's saying is, over time, over the next 5 years, the yield curve is expected to flatten. And to what degree? Look out at the 5-year. Look at the 5-year point of the curve. If you look in the lower left, you can see a 1-year point of the curve is 218. Go all the way over to the top column here, right? And you see the 5-year point of the curve is at 147 today. 5 years forward, boy, this thing is sensitive. I'm going to use this over here. Over here, right, it looks like it's at 245. So any increase in rates is already factored into the curve. Why is that important? Number one, if you're fearful about putting on longer-term assets because you think rates are going to rise, that's factored in the curve. Curves are never right. They're always wrong. The question is, how far off could they be? But for some of you, when we start talking about funding, whether it's short-term, long-term, one of the things I could tell you is, for example, if I take the 1-year point of the curve and I keep rolling up the curve every year over 5 years, and I average up all the increase in rates over that 5-year time horizon, it's going to average out to the same thing as if I were to take down funding today at 147. And so, as I've said in many of the previous webinars that we've been involved with, I said for most of you, you're asset sensitive. You're better off since you've got asset sensitivity. You've got more exposure to flat rates, falling rates, or if rates don't go up by much. So rather than go out on the curve and lock in long funding, right, you're better off paying as you go, even if the short end of the curve comes up. So I think that's an important thing to have in the back of our mind as we talk about strategies moving forward.
Real quick, this is Tom again. If anyone has any questions, please input them on the chat functions on the screen. Then we'll field the questions at the end of the webinar.
Thanks, Tom. So, with all of the things that are going on in the economic environment, that's creating some very dynamic changes in the credit union industry. And I think what you're going to find moving forward, as a matter of fact, I took this slide from one of the previous sessions that I did. I made a couple of changes, but we're likely to see fewer credit unions and larger credit unions. It's going to be very difficult for smaller credit unions, and when I say smaller, I'll say less than 250 million, to be able to keep the lights on with all the pressure on earnings, on margins, on revenue, on net income. It's tough to cover overhead when you're at that level. The old 1% ROA, I mean, I've always suggested that a 1% return on assets is a decent return on assets for credit unions. Now, half a point, ROA is now the new 1%. So what a lot of credit unions have done as a result of this low rate environment and feeling the pressure, they've looked for more fee income. And I can tell you that there are a lot of credit unions out there that are in markets where I work with a lot of banks, and the fees are higher than what we're seeing at the banks. And the banks are actually using it to their competitive advantage, which is kind of ironic. This next point, using wholesale funds. Everybody knows how I feel about the use of wholesale funds. And it's not because this is a commercial for the Federal Home Loan Bank. I've told you this before. Every single one of the credit unions that I work with the exception of one, which is a New York State credit union that doesn't borrow money, but every single other credit union that I work with has higher level of borrowings today than they've ever had. Their level of earnings is higher today than they've ever had, which begs the question, how come? Right? And we're going to talk about some of those strategies and some of the things that get in the way of using wholesale funds. But I think it's your friend, and if you're not using them, there are some huge opportunities right now, particularly in this low rate environment, to utilize the wholesale markets. At the end of the day, I think for most of us, net interest income is going to be the primary driver for driving income, and it's not going to be a function of more fees. So with that as the backdrop, what this implies is we really have to think differently. And I'm hoping I get some questions at the end of our session today, because I really want to flush out what are the issues, what are the things that get in the way of taking certain action. And by the way, I know the answers. That's more of a rhetorical question. I know what gets in the way, right? But I want to hear it from you. So we've got to think differently about our deposit strategy. If you're getting incented or compensated on deposit growth, that's not the most efficient way to manage an institution. But I hear that all the time. How about loan strategy? Should we hold mortgages, or is it not within our policies to be able to do that? It throws off our long-term asset ratio. It impacts our EVE. I don't want to hold fixed rates. Nobody wants ARM products. All of these things get factored into this low rate environment. How about capital management? I see a number of credit unions that have double-digit capital that are losing money. Losing money. And it used to be that the regulators would be fine with that because they would say, well, you know what, they've got so much capital, they can afford to do that. The last thing you want to do is start taking action today that's going to create more exposure down the road. And what do they mean by exposure, by the way? Rising rates. Regulators are deathly afraid of rising rates. It's just a bias. It's just, that's the way they are. How about liquidity? How much liquidity is too much liquidity? I would submit that probably most of you have way too much liquidity, right? And putting that liquidity to work is going to be beneficial to you. The question becomes, if we do that, does it throw off of our ratios? Do we have sufficient liquidity to manage the institution? Wholesale funding, we'll talk a little bit about that. Some of you have actually called me and had some questions on an article that I wrote for the Home Loan Bank in New York, I don't know, a couple of years ago, or whenever I wrote that. I think, is that on your website?
2012, yes.
2012, right? And I just laid out all the things that I think get in the way, and why if you're not using the wholesale funding market, you're just not very efficiently managing the balance sheet, right? And so I would encourage you to read that, share it with the board, and I think what you'll find is it's sound. It's for sound business, for making sound business decisions, right? And at the end of the day, it's all about survival of the fittest. And there's going to be some of us that survive through this, and there's going to be others that don't. So all I ask is, let's keep an open mind today, right? We're not going to really think outside the box today. These are not really outside the box thoughts, right? But let's just keep an open mind as we go through this. Now, I know what the regulatory issues are. I meet with the regulators all the time. I'm in Alco meetings for many credit unions every single day, day in, day out. I respond to regulatory documents or resolutions, letter of understanding. I've written policies. I've had more experience with credit union examiners than probably I have with any other type of examiner. So I know what the issues are. I know what the concerns are. I told you, they're worried about rising rates. All of a sudden, though, now what we're starting to hear is, I've got credit union examiners, NCUA, asking credit unions to put together capital plans. Right? This is about and these are credit unions that have high levels of capital. Right? The problem is they're not making any money, and no longer are they allowing them, right, to just continue to lose money without a plan in place. How about deposits? What is the stability of your deposits? All this money that came pouring into your credit union since the financial crisis, it's what's going to happen when rates go up. It's all going to leave, and then what are you going to do? How's it going to impact your liquidity? How's it going to impact your interest rate risk? What's core? What's not core? At the end of the day, and we spent a lot of time on this over the last couple of webinars, is getting down into the detail to be able to defend your position and understand, right, the volatility or the potential volatility of those deposits. And it's not hard. It's very simple, actually, but you got to put some time and effort in, and it's going to cost a little bit of money. Right? Other than that, these are the things that you ought to be doing. And you should have credit union specific assumptions. I know because I look at policies all the time from non-clients, or we'll have a credit union call us up because they need help with something, and I'll look at their Alco package, and what do I find? I find not credit union specific assumptions, but standard assumptions, industry standard assumptions. NEV is one of the biggest. We'll talk more about that. Static balance sheet. What does that mean? Everything goes back into the same product, right? No, that's not what it means. So we're going to talk more about that. Aggressive growth in long-term assets. Why is it that long-term assets are bad? There just seems to be this bias towards shorter-term adjustable assets, when in fact, most credit unions have so much long-term, non-rate sensitive funding to support long assets, they ought to be booking more long assets. The other problem with long-term asset to asset ratio is it ignores what? Your long-term funding. So we'll talk a little bit more about that. Stress testing, that's a must. You've got to do it, number one, for regulatory purposes. Number two, right, you ought to be doing it to get a better understanding of what your potential risk is if and when things change, right? Liquidity is always back at the forefront of discussions. I think for most of you, that's not an issue. You know, the fact that you have access to the Home Loan Bank, you have access to plenty of liquidity. So let's talk about the practical viewpoint of interest rate risk. And when I say practical, right, what I mean is, what are the things that we look at Alco? And by the way, I sound like a broken record, but I keep referring back to some of the webinars that we did before. We really dug down into the details as to what makes an effective Alco process. It should be a decision-oriented process, something that we do to facilitate dialogue, have discussion, develop strategies, and ultimately take action, as opposed to just something where somebody sits around, goes through the Alco package, and says we're within policy guidelines, and meeting adjourned. So strategic Alco, or do we get hung up on all the detail? There's a lot of things that are presented at Alco, and I know a lot of people's eyes glaze over. There's so much data, so much information, and there's so many things that you need to analyze. The question becomes, which ones are the ones that we should be focusing on? Now, one of the things that we talked about is looking at earnings at risk, right? That is the first and foremost priority that we have from an Alco perspective, as opposed to the alternative, which is what? Value at risk. We're not going to liquidate the credit union. So when we look at earnings at risk, we're going to see all these. Now, we believe that ramps are a reasonable approach to looking at changes in interest rates, because that's how rates move, not shocks. But we're going to look at shocks. And as I said to you last time, the time before, and the time before, if you do interest rate shocks and you don't make more money and perform better once you get beyond the first year, something's probably wrong. Something's wrong. Static versus growth. You know, we've got to start out with the basis of a static model. That's in the regulation, right? And then from there, we should be building in strategies. Strategies to consider, strategies not to consider, and growth moving forward or shifts. We're going to look at all these different ramps that we model out, and looking out at a 5-year horizon, it's going to show you a much different picture if we only look at year 1 or year 1 and 2. Right? Earnings at risk under a shock scenario. As I said, most of you should do much better. Now, when we look at earnings at risk, really, net income, the bottom line, is what we're most concerned about. There are a number of you that are well within your policy guidelines. Everything looks good until what? You get to the bottom line, and there's no income. And there's a lot of that going on now in the credit union industry. I don't have to tell you. I know you see the numbers. So earnings at risk is the key. Value at risk, we'll talk a little bit about that. I probably like beating a dead horse last time, but I still think it's something that gets in the way we're going to spend some time on. Stress testing, you've got to stress test earnings, you've got to stress test NEV, and a couple of things that I want to introduce to you, if I haven't already, is looking at the gap report. Regulators like to look at a 1-year gap. Sometimes we look at a 1-year gap. 1-year gap is basically useless. I think if you use a gap report as a database to see how things are flowing through the balance sheet, and if we're concerned about rising rates or we're concerned about having long-term assets, I'm going to show you kind of the poor man's version of how to look at your capacity to put on long assets, as opposed to looking at EVE or NEV, right? It's a very, very, very powerful tool. I'll introduce that to you if I haven't already. And for a lot of you, you're running a lot of different scenarios, and the question becomes, which ones do we focus on? We run probably 30 scenarios each quarter, right? I'm going to show you the ones that we focus on and why it's important that, we look at scenarios that we believe are reasonable, plausible, and not just the ones that we think the regulators are concerned about. So what are those core strategies? One of the things that we put together as a firm when the joint advisory guidance came out in 2010, if you looked at all of the requirements that were in that joint advisory guidance, and by the way, the joint advisory guidance, the reason they call it the joint advisory guidance is because it's among all the regulatory agencies to have some consistency. So it was the NCUA, the OCC, the Federal Reserve, all the regulatory agencies. And what I find interesting is that it's consistent among those regulatory agencies, with the exception of a couple of things that kind of stand out at the credit union level. And I'll talk more about that later when we talk about NEV, right? Your favorite calculation. What's the importance of this particular slide? When that guidance came out, they wanted to have earnings simulation run, meaning earnings at risk, under shocked scenarios. Now, we've always, by definition, had to run shocks for NEV. But all of a sudden now the guidance came out and said, we want to see what your earnings look like under these shock scenarios. Now, in one section, and again, I put this in my last webinar, in the guidance it says that interest rate scenarios should be reasonable and plausible. Right? They should stretch it a little bit, but they should be plausible. So our argument was doing a 300 basis point interest rate shock for net interest income, earnings at risk, is not reasonable, and it's not plausible. So what this graph shows is, the change, the average annual change in Fed funds, going all the way back to 1970, and that's over an annual. Right? If I were to take a 1-day time horizon So shock rates up 200, 300, 400 is not reasonable. And yet I know a lot of credit unions, right, that will measure to shock scenarios only. And they walk around their whole life thinking that they have exposure to rising rates, when in fact, they're asset sensitive. So we're going to try to get through that today when we look at some of these different scenarios. So let's talk about yield curves. Steep curves, flat curves, variable curves. A flatter yield curve is going to continue to put pressure on margins for most of you, particularly if this curve flattens by virtue of the long end coming down and the short end either staying where it is or actually going up. One of the things that I think might be useful information for you is, number one, there are several countries around the world right now that have negative interest rates. China, France. China just came out with negative rates the other day. We work with some very large institutions that are required. They're under this DFAST regulation, right? The Dodd-Frank stress test and everything else. Do you know what the stress test is for the big banks? Stress test for big banks is rates falling, going lower, not rising. Because as I showed you earlier in those graphs, rising rates is a friend for the commercial banking industry. You know, I look at the credit union industry, and while you guys are very different in terms of the makeup of your asset base, you know, you're pretty similar in terms of your sensitivity and your asset sensitivity. So one of the things that we run for the big banks is negative rates. How many of you run negative interest rates in your earnings simulation? You know, it was back in October we had negative interest rates on treasuries, right? And so what would happen if all of a sudden things take a turn for the worse here in the United States and we start to see negative interest rates? It's problematic. It's problematic enough to be in this low rate environment. So a flatter yield curve, you know, is the worst of all worlds in a low rate environment for most of you on this webinar today. How about the longer end of the curve? As the Fed tightens, slope does matter. If you look at these scenarios up here, that's up 400 over 24 months. Not a very probable situation. This is up 200 parallel over 24 months. Again, it's a requirement, right? Over here, though, what we're looking at is we're looking at flat up 2. What does that mean? Over 12 months, right? Bring the short end up 2%, flatten it out. Does that sound familiar? That's kind of what the Fed FOMC forecast was about a year and a half ago. That this was a little bit more aggressive. So a rising rate environment over here shows up 200, shows a very different picture than if we have a flattening curve. Flattening curves matter. What's this? This is down 100 on the long end. So how the long end behaves is going to dictate and have a big impact on your earnings stream. How about the pace of Fed tightening? Pace matters. And over here, what we're showing is, what if we bring rates up slowly? This. Okay. What if we look at, for example, rates going up 200, right, parallel over 12 months, versus if we do it more gradually over 2 years. Look at the difference. This shows a lot of exposure. This shows very little exposure. Right? Slope matters, particularly for those institutions that have near-term liability sensitivity, that feel compelled. I've got to extend out on the curve. I've got to extend my borrowings. I've got to get longer-term CDs. The reality is you probably don't. And by the time you get beyond 2 years, most of you, and most banks, right, in a rising rate environment, they got so much cash flow pouring in, they don't need protection any longer against a rising rate environment. How asset sensitive are you and when? Right? This is why we talk about shocks versus ramps. This is a shock scenario right here. Looks like if we shock rates up, life is good. The reality is that's not the way the world works or has worked. And so if we slowly bring rates up over 12 or 24 months, we have a very different outcome, right, when it comes to changes in interest rates. How about a liability sensitive institution? By the way, these bar graphs represent base case rates unchanged, right? This is up 2, this is up 400, right, and that's your shock. This one looks like, geez, I've got a lot of exposure to rising rates. That's only for the first year, year and a half. And then happy days are here again. That's why I said earlier it's important to look beyond 1 year. You know, if you were to just look at a 1 year time horizon or even 2 year time horizon, you might just assume that things will continue a downward trend, right? Whereas the reality is, right, it turns. Once the deposit, the rate increase abates, things start to turn upward. What if we bring rates up over the next 3 years? Right? That's going to look very, and then it might take a much longer time to recover. All these scenarios are important to kind of triangulate your position. This is, as I said earlier, when we're running a flattening scenario, right, over 12 months, and I prolong it over 24 months, look at the difference between up to parallel, up to flattening. Very big difference. And we're going to have different strategies. And I'm going to show you what we did with this institution. The person that runs this institution, believe it or not, runs a hedge fund, right? I mean, he's the chairman, right? And one of the things that we build in is the forward curve. We build in the forward curve for him. And I said, you know what? What we build in and in the actual forward curve, they're not all that different. But this is more close to the forward curve. A prolonged rising rate environment for them is better. I'm going to submit for you, because most of you are asset sensitive, I'm assuming, right? The faster rates go up and the sooner they go up, the better you're going to be. This is going to be exactly the opposite. Now, here's the forward curve. So this is the curve that we run for this particular institution. This is the one that we run, flattening curve, and look at the difference. They're almost on top of each other. So that up 200 delayed over 24 months is pretty close to what the forward curve is telling us. So with all these different scenarios, the question becomes, you know, what do we do? What are some things that we ought to be thinking about in terms of strategies? And we'll talk about that. Now, here's a liability-sensitive institution, right? And I can tell you, this is one of my credit unions. They have had this exposure like this for as long as I've worked with them. And we've taken a lot of heat and a lot of pressure from regulators. And they've stood their ground, right? And I'm going to show you their NEV in a little while, right? But these are not very reasonable, plausible scenarios. And the fact that they have this much exposure to shocks for the first 3 years says they've got a lot of longer assets on the books. And I can tell you right now, they earn over 1% ROA, despite the fact that we've got to defend our position every single quarter with the regulators. So, what are some of the concerns about going out on the curve for some of you when it comes to interest rate risk? You know, I know and I understand NEV is a big issue. The regulators like it. It's a sophisticated calculation, but I went through a lot of the detail on the difference between what NEV tells you and what it doesn't tell you. And everybody should know that cold. I'll spend a couple of minutes going over it. Quite often, what I find is a lot of credit unions use a non-maturity deposit average life at 2.5 years. Where did that come from? Does anybody know where that came from? I don't know where it came from. That NERA study that they did many, many, many years ago, which they threw out. And yet, many of you still use that. If you think that the average life of your non-maturities is 2.5 years, I think you need to go back to the drawing board, right? Most of the studies that we've done, right, are anywhere between 6 and 8 years. And we can defend it. Some of you use PAR, meaning zero average life. So here's one credit union, right, that has a 5-year average life, a 2.5-year average life, and a 0. I'm going to have very different concerns, and I'm going to have very different strategies if I look like this, which is the higher rates go, the better off I am, versus this, which is a decline as rates rise, versus I'm out of business if rates go up, theoretically 400. Right? So we spent a lot of time on that last time. I'm going to show you probably the most important things to look at NEV calculation. Right? What is NEV? At the end of the day, it's a liquidation calculation. And the reason I want to spend some time on this is because I know this is something that gets in the way. So everybody understands what book value is, right? I'm a recovering accountant. I know what book value is. We're all familiar with what's on the books for. But then what we're going to do is we'll look at zero shock. If we had to liquidate the credit union today, based upon market values of assets and liabilities, what's left over? In this particular case, $128 million left over if we were to liquidate based upon current market value. Right? That's almost 19%. So the regulators could throw a heck of a party if they liquidated, right? What if rates were to go up 400 overnight, and then we had to liquidate? Now we're at 140 million. which is almost 22%. That's even stronger than what we started with. What's the key driver of this whole calculation? It's right here. It's the value of those non-maturity deposits. You'll notice that down here, what does that say? 503, 803, whatever it is. I think that's a little over 5-year average life. That is what supports their ability to go longer term on the curve. So if you're using anything less than 5 years, right? Use 5 years as a surrogate, and then stress it from there. That's the NEV calculation. And if you understand that, number one, they want to know what's the percentage change. That's number one. And then number two, which I think is even more important, not so much the volatility here, but what's left over at the end of the day. You got plenty of money left over and a pretty darn strong capital. Now, here's the poor man's version, poor person's version, right, to be politically correct. This core funding utilization, what does that mean? Why is it important? If you look at your gap report, and as I said earlier, some people look at the 1-year gap, that's useless. Let's look at the 5-year and beyond gap. If you go over your gap report right now and you look at how many assets do I have either maturing or repricing beyond 5 years. In this particular case, right, this credit union has $109 million. So that begs the question, is that good or bad? What's funding that $109 million of long-term assets? Well, if you told me it was overnight borrowings at the Home Loan Bank, you might have some exposure. If you said it was money market accounts, we'd have some exposure. The reality is, let's start with the funding. And let's start with the longest asset first. We're going to fund the balance sheet. So how am I going to fund this $109 million? What's the most least cost, zero rate sensitive funding source on the balance sheet? It's your equity. Heck, I can do almost 75% of that just funded out of equity. Right? Then I can go down to my DDA accounts, my NOW accounts, my share accounts. Right? I've got in my checking accounts here, I got $67 million. So between the 77 and the 67, I can fund all those long assets. This is long-term, non-rate sensitive funding. That doesn't mean that we don't move our share rates up, we don't increase our savings account rates, right? But it's long-term, non-rate sensitive. Once I get to my checking accounts, I got $40 million of excess long funding. I go to my share accounts of almost $200 million, now I'm up to $228. So by definition, if these are not dollars that are funding long assets, what are they funding? They have to be funding a shorter asset. So they're only utilizing 32% of their long-term funding capacity. How has that been over time? Well, when we first started working together, it was down to 14. It was below this, actually. So I got them to 14, then 16, then 20, then 27. Now we're up to 32. So what does that mean? We're adding more and more longer-term assets because of their asset sensitivity. And they're still mismatched on the balance sheet. I'm going to show you one that I did yesterday. I had a meeting yesterday with a client, right? And this was their core funding, right? Now these guys, as I said earlier, they're improving, meaning they're putting more long assets on. This particular institution, their core funding is low. They're only at 25%, and they've been at 25%. It hasn't changed. And so I said, even under the worst case scenario, in a rising rate environment, right, you still have only 27% of your long funding long assets. If rates rise, we have extension risk on the asset side. We've got $663 million of assets beyond 5 years. And by the way, that includes property, plant, equipment, real estate owned, right, non-earning assets. We've got $1.7 billion left over of long-term funding that's not funding a long asset. And let me tell you, these guys are so asset sensitive. And so they finally agreed, a light bulb went off, right, that now we can start to hold long-term fixed rate assets. And they agreed to do up to $700 million. They don't want to use up the whole thing. You take $700 million of assets at an average yield of somewhere between 4.50 and 5, because they do other types of loans, and you're funding that at a 4.40 spread out of the gate, do the math. That's a lot of income. That's a lot of income. Right? You can do the same thing. Deposit behavior. One of the things I can tell you is if and when the Fed raises rates, right, how you move your deposits is going to be critical. I'm going to go back a slide, back to this core funding. One of the board members at this particular institution, this was yesterday, asked me, Frank, if the Fed raises rates again, how much do you think we should move our non-maturity deposits? And I gave him my answer. And he said, well, you know what if we were to raise them 10 basis points? Right? 10 basis points on your non-maturity deposits that you pay interest cost you $15.5 million. So if I were to give you $15 million marketing dollars, how would you spend it? Would you spend it on giving everybody in their money market 10 basis points in savings and checking? Or would you take that money to invest in technology, doing some other things? You know, I know what I would do. And so when you come up with a dollar amount like that, their eyes open really wide. And do you really think people are going to move for 10 basis points? I can tell you every single client that we work with as a firm, everyone I work with for sure, we have not moved any of our accounts 1 basis point since the Fed raised rates. As a matter of fact, we brought some down, particularly on the longer end. Okay, deposit behavior. We could spend a lot of time on this. I'm not going to spend much time at all, other than to understand that, you know, we all know that in 2008, right, rates started, this is short-term rates, they started coming down fast and furiously, just like the long end did. We had a shift from going from CDs into money markets. That hasn't changed. Our cost of funds has come down, 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 and down, with very little to go. The question becomes, moving forward, how can we expect that change in mix to fluctuate, right? So 20 to 25% of your non-maturity deposits is greater than trendline growth. The best thing I can tell you the best investment you can make right now is in a core deposit analysis, because that's going to influence a lot of the things that you do and allow you to get down to the account level. Who's got relationships with us, multiple relationships, all those things factor into how you should be pricing. So the important first point here is deposit pricing discipline and strategy moving forward. This is a key business issue because there's so many dollars at stake. And as I said in that last example, 10 basis points on an institution that's got over 60% of their funds in non-maturity deposits has a huge impact. So the question becomes, if I do 10 basis points, how does that impact my expense, and how do I make that up on the income side? So cost of funds management. This is toilet training for most of you. We've been through this a number of times, but this is a real-world example, right? I'm assuming most of you have a lot of liquidity. So unless you're up against the wall in terms of liquidity, let's assume for simplicity, you got $50 million in a high-yield money market at 35 basis points. The Fed raises rates a quarter, like they just did. What do we do with this account? I can tell you board members, and don't take this the wrong way, board members, particularly at the credit union industry, don't truly understand, right, the impact of some of these marginal transactions or marginal changes, because they don't live, eat, sleep, and breathe this every day like we all do, like you do. So let's assume that somebody wants to grow deposits and wants to bring that rate from 35 up to 60. The question becomes, if I do that on the whole dollar amount, what am I protecting? Do I really think dollars would leave? I can tell you none would leave, first of all. Second of all, if they did, heck, I can borrow money at almost the same rate. If we think we're protecting 10% from running off by paying up 25 basis points, the marginal cost of that decision was 2.85%. For 2.85%, what we're saying is 90% of the money is non-rate sensitive, but we're going to try to hold the other 10. I'd introduce a new product, first of all, if I thought it was rate sensitive. Second of all, the marginal cost at 285, that's a big expense. How far out can I borrow money at the Home Loan Bank at 285? I could probably go out over 10 years. I know I could. I go out 10 years at 280, right? Now, you tell me that the average life of your non-maturity deposits is more than 10 years, well, then we shouldn't be using 2.5 in the NEV. But either way, right? And by the way, when I borrow at the Home Loan Bank to replace that at the margin, right, I protect, right, paying up on the rest, cannibalizing. Now, this gets a little more detailed. I'm going to keep this very simple. If we were to go out with some special, and I know everybody wants to do a special, get ahead of everybody else, and I know a number of you that probably did that, right? And you got ahead of everybody else, all right? Now you're stuck. You're stuck with these high-cost deposits, right? So this is all about cannibalization. If we have a deposit base like I just talked about at 35, rather than raise the money market account rate, let's come out with a special 7-month CD. That's too short, first of all. Second of all, at 125, that's way too high. So it begs the question, how much am I going to cannibalize? Number one, right? And number two, if I do cannibalize a certain percentage, what am I going to do? What do I have to do with that money just to make back the expense? So what this thing does is it walks you through. I'll assume that we think we get 30% conversion. And by the way, that's a number that is probably reflective of what you might expect or more. But let's say 30%. Right? Now all of a sudden, my weighted average cost of these dollars, 35, and then the cannibalization, that gets me to 62 basis points. My interest expense just went from 175,000 to 310,000. So that cost of conversion of 135,000, I've got to go out and do, I got to go grow assets almost $7 million at that 2% spread just to cover that cost. Where's that growth going to come from? That's a very expensive decision. That's all I'm telling you. And as simple as this is, these are things I would walk my board through and senior management just so that they understand the impact of some of these decisions about CD specials. A second point on deposits, and then I promise I'm getting off this deposit strategy. Right? How core are your deposits? Look back at the other sessions that we did, and it really gets down into the detail as to how to get a closer look at those core deposits. And I would encourage you, if you haven't done a core deposit study, to do one. And I don't care if you do it with us, if you do it with somebody else, just do it. Right? Now, a while ago, I talked to you about an article that I wrote, and I did this only because there was a little sense of frustration. Right? I spent so much time, right, trying to get people to understand the economics of using wholesale funds, and for some reason, it just doesn't always sink in, for lack of a better word. So it's, I'm going to write an article on this. Right? I've heard all the excuses. My board doesn't like it. We don't like to borrow. It's too expensive. I mean, I've heard them all. Right? So let's just separate fact from fiction. And I wrote an article, and I think if you do read that article, share it with your board. I think it might help to get your board to think a little bit differently. But one of the things that occurred to me, I did these rates as of yesterday. Look on the short end of the curve, 60 basis points, right, all the way out to a month. Right? For those of you that aren't familiar with this community investment program, I can tell you, if you can't get approved to access this money over here at these rates, something's wrong. Call me. I'll show you how to do it. I worked at the Home Loan Bank. I know all the requirements and how you can go about getting these things accomplished. All right. So I'm going to focus on this side over here. But let's just start with the short end of the curve. Let's assume that you did want to use short-term dollars. Let's say you have a lot of capital, you want to leverage the balance sheet. And I'm going to show you lots of examples. What's the most effective way to do that? 7-month CD special is not the solution. You might not even break even on that. If I've got a lot of loan demand, right? Should I go out and do CD specials? What should I do? Right? One of the things that I think slips by a lot of folks is understanding the dividend impact. If the Federal Home Loan Bank is paying you a 4% dividend, 4.10 last quarter, right? You have to own about 1/20th of stock to borrowings, right? So let's call it 5%. It's not exactly, but it's about. So that's about 1/20th. Let's assume that we borrowed money at 60 basis points, and we get a dividend of 4.10 from the Home Loan Bank. That's a difference of 3.5%. But you only get the benefit of 1/20th, right, or 5%. What's 5% of 3.5? 17.5. So I round it to 18. So if I borrow money at 60 and I factor in the dividend rate of 18, net, I'm down to 42. So this is really 42. You could borrow at the Home Loan Bank, stick in overnight funds, and make 8 basis points. Believe it or not, I mean, you could. What's the other thing? There's no insurance premiums. Do you think, by the way, NCUA insurance premiums are going to be gone forever? They always come back, right? There's no insurance premiums on that. We don't cannibalize our existing deposit base like we did with that 7-month CD special I talked about. And it's the least cost funds, least expensive source of funds at the margin. So what gets in the way? Why is it that some of you don't use the home loan bank, don't use wholesale borrowings? Right? And again, it's a rhetorical question. I know the answer. My board doesn't like it. We have too much cash. We don't have loan demand. Well, you know what? That's a whole other set of problems and issues that we need to talk about, which I'm going to talk about next. But I'm just telling you right now, if you're my CFO and you're not using the home loan bank, I want to know why. I seriously, I want to know why. And if the CFOs are sitting there thinking, oh, geez, I don't want you coming to my credit union, that's fine. I'm just telling you, if you're not utilizing the wholesale markets, then you're not operating as efficiently as you could. And I'm not saying forsake your members, forsake your depositors. All I'm telling you is, right, margins are coming under pressure. Costs are going up. And if we can complement our retail strategy with a wholesale strategy, net, we're so much better off. So what if I'm asset sensitive? Right? Here's an asset sensitive institution. Right? The higher rates go, the better we are. Even if we have a flattening yield curve. This is the down 100. Now this particular institution, right, is, look at the base case scenario, rates unchanged. That's unusual. I see most credit unions down in the base case. So if I'm asset sensitive, what are some basic fundamental things we ought to be thinking about from a strategy perspective? Let's consider the following. What's our capacity to understand our ability to extend assets? Let's go back to that core funding utilization. That's an easy place to start. And by the way, what's going to impact your core funding utilization? Go back to that section after today's call and look at what I put in that long-term non-rate sensitive funding. If you're gapping a lot of your checking and savings accounts short, it's not going to work. Those are longer-term non-rate sensitive sources. We should be extending cash if we're asset sensitive. Maybe do some mismatched leverage. What's that mean? Maybe put on some 1-year, 2-year, and short-term funding and put on some longer assets. So even if rates rise precipitously, by the time the funding rolls off, we're printing money, right? Holding fixed rate mortgages. There's a bias against holding fixed rate assets, right? We'll talk about that as well. I'll give you some examples. And then how about longer term business loans, commercial loans? A lot of you have gotten involved in that. Heck, nobody can be more competitive on funding and rates and terms than a credit union when it comes to this market. I wouldn't repeat that in the banking circles, but I'm telling you, you guys have a lot of flexibility. What if I'm liability sensitive? What does that mean? Right? What that means is, right, near term, I've got some exposure to rising rates. Longer term, once I get beyond 2 years, I'm printing money again. So what are some things if we're liability sensitive? And again, it depends upon the degree. What's the magnitude of your exposure? Is it near term, long term? I tell you, if I've got this exposure here, based upon where I think rates are likely to go, I'm not doing anything in terms of extension. I'm just riding that thing up, right? I'd be more concerned about rates not going up and rates coming down because I can't do anything. I'm backed into a corner if rates start coming down. Just like we're seeing with a lot of European countries right now. They give their eye teeth right now to have the opportunities that most of you have right now, all of you have right now on this phone call. Right? So don't take it for granted. If we're going to extend our funding, how far out do we go? In other words, how much insurance do we need against rising rates? That's an important consideration, which again is a reason why you can't just look at 1-year, 2-year simulations. You got to look longer term, right? Have a deposit pricing game plan in place, and don't wait until you're in the heat of the battle to talk about specials and what everybody else is doing. Stick to what's best for your organization. Should we shorten assets? I put a question mark. Asset liability management 101 would say extend funding, shorten assets. That is not the solution in today's market, right? So one thing I've said over and over and over, I sound like a broken record, is there is a no one-size-fits-all strategy. I'm going to show you a variety of different strategies, and I'm going to open it up for questions. Okay. I did promise to talk about investment strategies. I'm just going to give you the quick and dirty. Anybody who's ever known me, for as long as you've known me, I've always said the same thing in terms of my feeling about callable bonds. I've always said to you, avoid all callable bonds, and if you ever get the urge, call me. Any time of day, night, we'll get through it together. It's a sucker bet, always has been. Worst investment, one of the worst investments you could find. I don't care if it's a step-up callable, regular callable, discount callable, avoid them. And if you don't believe me, call me. Send me a bond, and I'll show you mathematically how it is a sucker bet. You shouldn't be building cash at this point. You got to be aware of premiums. I see so many of these credit unions now paying huge premiums on stuff, right, including CMOs. Now, I spent a lot of time understanding CMOs, right? And I'm going to tell you, I'm not 100% perfect when it comes to analyzing CMOs, but I think I understand them pretty well. And yet I see smaller credit unions, and even some larger ones, that get involved in buying CMOs. Do you really understand CMOs? And if you don't, just keep it simple. I've yet to find somebody that really, truly understands them. I have one client that buys them, one credit union client, right? They understand them very well. I'd say the others, quite frankly, don't, right? Look at loans. Look at 30-year fixed-rate mortgages at 4%. Now they're probably 3.75. Compare those to what you're doing on the investment side. Heck, if you can get 4% on a 30-year fixed-rate mortgage, as opposed to buying a security for 5 years at 1.25%, you know, which one has more risk? I would submit that if you're stuck with 1.25% for 5 years versus 4%, you're never going to catch up. It's going to take a long, long time to catch up, right, to the earnings lost by staying short on the curve, right? Extension risk. What are the concerns, right? Can we support? We can support long assets, right? Whether it's 20-year mortgage rates, 15-year mortgage, Dutch bonds, you know, with our core funding utilization, running simulations. The key question here is, if you don't have a lot of loan demand, how are you going to offset your margin compression? How about earnings, right? I think for a lot of you, you've got the capacity to put on longer assets. I would rather do a barbell approach of holding some cash and 30-year mortgages than going out and buying 3 to 5 year assets. Net, you're going to be better off from an income perspective. Now, I've got a ton of strategies in here. I added a ton of these this morning. It was not my intent to add so many. I'm just going to hit on a few, and then I want to open it up to questions and your thoughts and find out really what's on your mind. Here's a pre-investment of cash flows. What does that mean? If you don't have a whole heck of a lot of loan demand, you've got exposure, right, to falling rates and flat rates. Let's not wait until that cash comes in. And this is where you can, you know, pick up the phone. In this case, let's assume that we borrowed $35 million, and numbers aren't that important. Borrow short term, put on long assets, and then as your investment cash flows pour in throughout 2016, pay down the borrowings, or keep the leverage on at will if rates continue to rise. If they don't rise and you're facing reinvestment risk, that's a problem. Look at the incremental impact of this decision. It's a win, win, win in every scenario with the exception of, well, all of them. Right? That's a pre-investment. I'm going to give you a couple of examples, and there's a ton of others in here that you're going to have to go through on your own. It was not my intent. Loan demand is critical. Loan growth funded with investments in Federal Home Loan Bank borrowings, right? Here's $20 million worth of growth. This is what we look like before. We're asset sensitive. This is what we look like after with $20 million of loan growth. How would you fund that loan growth? All we did is we took investment cash flow rather than go back into investments, and we needed both investment cash flow and FHLB borrowings. How would you fund that? You don't need long funding. I don't care if these are 30-year fixed-rate mortgages, right? So we did some long loans, we did some ARMs, we took bond cash flow, and we looked at longer-term advances. So the big question is, why did we use longer-term advances? Because that's what the client wanted. They didn't feel comfortable despite how asset-sensitive they were. So do we really need term borrowings? No. But for some, you feel better. I'd fund that whole thing 100% short. Right? Look at the difference. Right? This is where we were. This is where we are. We're better off in every single scenario. Now, what's the impact on our liquidity? This is something I do for one of my clients that the regulators are all over them for all the growth that they're putting on, all the strategies. What's going to happen to your liquidity? This gets a little more detailed than I care to go through, but right, they've got to meet their minimum requirements. We ran all the scenarios for them. Here's another example. Loan growth if you've got exposure to rising rates. Right? Here's a one-year growth model. This is static. This is what we look like. Look at the exposure that we have to rising rates. There's a lot of exposure out almost 3 to 4 years. Does that mean we need to extend our funding? No, because once we build in our expected growth over the next 12 months, that has a huge impact on our decision for funding, how far out we go, etc. Here is all the assumptions down at the bottom, right? Look at the incremental impact. In other words, I don't need to buy protection against rising rates. How about getting the cash out? Some of you that are still sitting in cash, you may have heard me say this for the last 5 or 6 or 7 years. You're like Linus in the pumpkin patch, waiting for the great pumpkin to arrive, and while you do, it's costing you a lot. That's a big bet that you've got on the table, and even now, given where we are, I still think you've got to get that cash out, particularly if you've got exposure to flat and falling rates. So here's $20 million worth of loan growth using investments and cash. What's the incremental impact of doing this? This is where we are today. Here's the strategy. Here's the incremental impact. And if you show these results at Alco, how could anybody not execute that transaction? That's a big, big, big difference, right? Last but not least, earnings enhancement, capital management strategy, AKA leverage. It's a bad word. People don't like the word, right? But it's leverage. What if we bought mortgage-backed securities? Look at the asset sensitivity of this institution. Buy mortgage-backs, fund it short. Doesn't that go against the grain, right? But what's really funding these assets? It's not the short-term borrowings. It's all that core funding that we talked about in the core funding utilization. And then last but not least, extension. If you really have extension and you need to buy protection, I might go out 2 to 3 years if I had to. But if I do that, that's going to cost me money. What's the earnings impact of extending? Then what I'm going to do is, not only am I going to extend my funding, I'm going to grow the balance sheet. I might do some mismatch leverage, mismatch growth, right? So that once I get beyond that 3-year time horizon, my asset sensitivity starts to kick in. That way, I buy the protection and I pay for it by putting on growth. Now, here's a ton of strategies. I'm not going to go into every one of these, but using investment cash flow going into loans, holding loans. That's one strategy. Putting portfolio mortgages in that might not feel comfortable, and then being a little less aggressive on your non-maturity deposit pricing. If you've got loan demand versus not having loan demand, has a huge impact on some of the strategies that you're going to consider. So I'm going to let you go through these at your leisure. And key takeaways that I want for you to have today is, number one, margins are under pressure. They're probably going to continue throughout 16 and beyond. And at some point, knock on wood, we're likely to see a recession. And if and when we do, right, we're going to probably see, rates come down again, and you might even see some credit issues. In which case, we have to make sure that we build a fortress of income and capital between now and then. Rising rates helps. The question is, when are they going to rise? And in the meantime, we can't just sit and wait. Flatter curve is going to require either a change in mix from more investments to loans or adding more assets to the balance sheet. The wild card, and I don't think there's going to be much change here, is on the deposit side. And then probably most important, opportunities exist now. Take action that fits your credit union position and not what everybody else is doing or what you're hearing or what the regulators fear. You've got to be able to defend your position. And as I said, wholesale funds, are your best friend. Use them to your strategic advantage because others are. And I know the credit unions that use wholesale funds, and I know the ones that don't. And the ones that do, they do it out of a position of strength, not out of a position of weakness. And I know that's something that is hard sometimes to get over, particularly with board members. Read that article. I think once you do, I think you'll feel a little bit differently. If you have any issues or concerns about using the wholesale markets. And that's what's on my mind. I think a lot of that was on your mind. But at this point, we probably have about 20, 25 minutes. Let's open it up to what you guys want to talk about.
Okay, so we're just pulling up the questions now. I just want to let you know that this presentation is going to be sent out via email tomorrow to all the participants. This webinar is also going to be available on our website, and past webinars are out there already. We'll include the past webinars on the landing page that we send out to you guys. Also, the article Frank's been referencing, it's a 2012 article called Mirror, Mirror on the Wall, Is Your Funding Strategy the Fairest of Them All? That will also be included on the landing page that we provide to you guys. But the first question that we see here today is talking about net worth ratio. And one of our credit union members stated that their board really likes the high net worth ratio, however it impedes earnings. What's a reasonable net worth ratio to manage your balance sheet for a typical credit union of approximately $100 million in assets, 50% assets mortgage related, and the rest short-term loans? So I'll let Frank answer that.
Okay, so as I understand it, what is a reasonable net worth capital ratio, right? Given the makeup of their balance sheet, at the end of the day, there's no right answer, but probably the most important thing is if you've got 50% of your balance sheet in mortgages, or I should say loans, right? What kind of loans are they? If they're taxi medallion loans, I'm going to have a different answer. If they're high-quality residential loans, high-quality auto loans, etc., then it all comes back to how much capital is sufficient, how much is too much, right? What is the cost of capital? Now, if I'm struggling with earnings and I'm asset sensitive, and I've got half my balance sheet in securities, that begs the question, how come? And if I don't have the loan demand, I'm going to start holding loans. If I can't get the loans, I'm going to go buy the loans. If I can't go buy the loans at a reasonable price that I'm comfortable with, then I might look to extend out my funding, right? And I think depending upon the size of the organization, that makes a difference too. But some credit unions think higher capital ratio is stronger, and in fact, it's not. At the end of the day, it comes down to earnings. And if you're not making much in the way of money, but you've got a high capital ratio, and I see a lot of that, right, then we probably need to use that capital more effectively, more efficiently. As I said, start with loans, and don't be afraid, right? And if you're trying to protect your capital ratio and you've got earnings challenges and you only have 50% loan to asset ratio, I'd rather see you hold 30-year fixed rate mortgages, high quality ones, at 4% and keep some money short than to have half your balance sheet and investments out 2 to 3 years in low coupon callables or treasuries or agencies or whatever it is that you're buying, right? That's probably where I would start.
Thank you, Frank.
And I know that's a tough question.
We have another question from one of our other credit union members. They wanted to know about what the right approach was to model the betas of non-maturity deposits in a rising rate environment.
Aha, terrific question. Look at my last webinar, and I spelled it all out with all the stress tests, but I'll give you the short answer, and that is number one. And I would be happy to send along to you some of the things that we do. I'll send them, anonymous here, I'll send them to Tom, he can send them off. But first and foremost, this is where a non-maturity deposit study comes in handy. Number one, because you've got history of how these deposit balances have behaved, how you've priced them previously, and then you start with that. Secondly, you run stress tests that say, what if we're wrong? And I'll give you the stress test that we run that I think will be helpful to you. And then thirdly, how much of these non-maturity deposits in a rising rate environment are going to migrate out or shift? I'll tell you, one of the things that we do is we assume that in a rising rate environment, 25% of those non-maturity deposits are going to migrate out into, and we pick the 1-year point of the curve. We use 1-year FHLB borrowing rates as the surrogate. So you call it CDs, call it whatever you want to call it, but a 1-year point of the curve, right, at current market rates. And that'll give you a flavor and a sense for, right, what your balance sheet would look like if you had that migration, number one, and then secondly, if you had to pay up more. So we run a number of different stress tests that I will share with Tom that he could forward to you to go through that. But that is a key consideration. So I'm glad you asked. How do you measure deposit decay in a mobile banking world? Considering smartphones were not introduced into 2008. Nobody has an answer to that. So that's a very good question. However, what I can tell you is that's going to be largely a function of, and we have a lot of clients that have that. And we have some very, 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 very large institutions that have given some thought to that. I would be happy to share some of that with you offline because it's a more detailed answer. But to the degree you got to look at balances, you've got to look at the stickiness of this, other relationships, fees, rates that are being paid, etc. And I think that goes a long way in trying to separate the different depositors and how rate sensitive they are. I can tell you, if you have mobile banking, via your phone, and they have direct deposit, and you're not paying a lot of money in that account and they keep low balances, that's probably a pretty sticky account. So there's a lot of things that go into decision making for that. And we've done some webinars on all this stuff that I think it's recorded. I'll direct you to that after this session. Somebody else has a question on high quality 15-year fixed rate commercial loans in this market. A good idea. I think it's a good idea in any market with higher yield than our 5-year product. Okay, so here's the question, and that is, when you say introducing a high quality fixed rate commercial loan, I actually had in here, but I took it out. I shouldn't have, but a grid, a matrix that shows the point of indifference between floating rate commercial loans and fixed rate commercial loans. And so, I mean, I don't know, can you flip back to the FHLB deposit pricing sheet, or I can just give you these rates? But let's assume that this high quality commercial loan comes through your door today, and they want a floating rate asset tied to prime. What's the rate? I assume you're going to give them prime, 350. All right. So effectively you said, I need a 3% spread, risk and cost adjusted, right? Then the person comes in the next day and says, I've had an epiphany, I changed my mind. I want a 15-year fixed. Now, I'm assuming this is a 15-year fully amortizing loan. I don't care if it's 15-year fixed, fully amortizing, or 15-year fixed with a 25-year AM. All I'm going to do is I'm going to look at how do I price that the same way I would price a floating rate loan to get the same required spread. That's where you can use a prime swap curve. All right? I thought that was a little bit beyond today's discussion, but I did have that slide in there. So, you know, what I would do is, for example, I'm going to assume it's 15-year fixed, 25-year AM. What's the average life of that? About 12 years when you factor in the amortization. So I theoretically could go to the home loan bank, just as an example, and find out what would it cost me to borrow money for, an average of 12 years, right? You're probably talking somewhere around 275. I take 275, I add my 3% spread, that gives me 575, right? I can tell you, if you go up 575, you're not going to get any deals. You're probably looking more at 475, 4 7/8. If it's a fully amortizing 15-year fixed, then, and I need my required spread, then I can get funding costs at probably somewhere around 175 at the home loan bank. And I'm not saying use the home loan bank to borrow 7-year money. You probably don't have to borrow long money at all. But let's assume that you did. You know, there's about a 4.5, 475 cost, right? And you're probably going to, be able to build operating accounts, have bigger, you're going to be more competitive in the marketplace. That's the same example I had with that other institution. I told you it's got $1.7 billion in excess long funding. That's exactly what they're up against in the commercial arena. And they're saying we're losing deals because we've met our max in terms of what we're willing to put on for fixed rates. So good question.
All right, I think that's it for today, everybody. Frank, thank you very much. Just want to let you know that there's a short survey at the end of this webinar, and we appreciate your feedback. Again, like I mentioned earlier, this is a part of a series, and we really want to have this series continue, and we really want to be responsive to what your needs are and what you desire to hear in these webinars. So let us know. You can send us by email, or you could put some feedback in the survey. But we appreciate your attendance, and that's it. Frank, do you have any last things?
I do. One of the things that we've talked about here at Federal Home Loan Bank in New York is trying to put together kind of a road trip, right? Me and Tom and Angel to go around New York. This is where I grew up. This is where I was born, and maybe finding a handful.
And New Jersey as well.
No, New Jersey. I'll do New Jersey. I didn't grow up in New Jersey though, but I'll go to New Jersey. And for some of you that are struggling with this, and you say, you know what, I don't even know where to start with this stuff. You know what, I had this old approach. As a recovering accountant, we used to go with the shoebox approach when people used to throw all their stuff in a box and say, here, do my taxes. So if some of you are interested in taking your Alco policies, your Alco reports, minutes of your meeting, the more the merrier. Just throw it all in and give it to the guys at the Home Loan Bank here, and I'll pour through that stuff, right? And I'll give you kind of an overall assessment of where I think there's some opportunities for you, some of the things that get in the way, policies. Are your policies flexible? And if you want, I'll come out and spend a couple of hours sitting down with you, senior management, and the rest of the group, just going over your Alco package and some things that I think you ought to be thinking about to get a running start in 2016. And to the degree that we could get 5 or 10 of these and spread them out on a road trip, I can make it more efficient. Whether we do it in the next few weeks or if we do it in I'm doing something somewhere in Rochester sometime. May.
Yes.
All right, so even if it's out sometime in May, that gives you more time. I would be happy to do that. I committed to doing that. Take advantage of it because it comes out of your dividend at the Home Loan Bank. So take full advantage of it. But all the things that we talked about today, if you have any questions offline, send them to me, send them to Tom. If you think it would be helpful, just do that little shoebox approach. We could do it over the phone. We could do it in person. Anything that I can do to help make everybody's life easier, maybe add some clarity to some of the issues that we talked about today. I know we've got a variety of folks on the phone, from smaller institutions to very large, sophisticated institutions, and I can talk turkey with with all of you. I've got credit unions that I work with that I've worked with for 15 years that are less than 40 million, right? And I told them, I said, when my 401k surpasses the size of the credit union, that's a problem. So we got to get this thing moving. I'm a long way away from that, let me tell you. And then the others, I work with some very large credit unions that all of you know. Some of the top 3 credit unions in the whole country. And you know what? The issues are the same. The struggles are the same, right? They're no different. And so to the degree that I can share my experiences with you, my thoughts with you to kind of get you moving in the right direction, or just confirm some of the things that you're doing now, I'm happy to do that. If you have any regulatory issues, concerns, things that you're having to deal with, I've written responses for just about every possible thing the regulators could come up with, right? I'm happy to share that with you. You can use it, change the date, change the name, change the circumstances, but you know what? I think they're pretty effective. They've been so in the past. I'm happy to share that with you. So with that, I thank you. I thank the Home Loan Bank folks, and I hope that was a worthwhile use of everybody's time, and happy Groundhog Day.
Happy Groundhog Day, everyone. Thank you very much, and we'll be waiting your feedback via the survey, and again, feel free to contact us or email us with anything or any comments that you have. So thank you very much.